So when we look at the market makers, they're going to use mathematical market probability statistics, and that's what we want to do as well. So they're going to use that for pricing the movement of the option into its expiration. So by knowing the probabilities of your underlying security finishing within a certain range at expiration, this becomes key to determining then which options to buy or sell, and then what option strategy to use. So these statistics will forecast how likely it is that a security or a stock price will fall within a certain range, option series range, price range, up or down by its expiration. And this forecast is what we call or refer to as the implied move or expected move of your stock. Now, this implied move is a theoretical estimate of a plus or minus 1 standard deviation move of that security over its option cycle. So this is what we're going to start out with to kind of give us a price forecast. And I kind of refer to 1 standard deviation based on the option cycle as kind of a normal potential move that a stock or security can have. Now, when we look at these statistics, we'll just go through this here in a minute, but based on these probability statistics, the selling options and vertical credit spreads, when used correctly, is going to provide you as a trader or investor a greater probability of success. And they can become a great way to generate a kind of a steadier stream of income and are great for hedging. So by selling out of the money, like a 1 standard deviation out of the money option, you're going to basically theoretically start out with an 84% chance of winning. So when we look at option delta, that's going to how we kind of back into our probabilities. So for example, this is a normal distribution chart to show you data. And this is price data. So at the money, let's see, here's the market's trading at $500 at the money. Now, when we look at the probabilities of where it can go, we can use option delta. So for example, here, this would be, let's say this is an expected move of plus or minus 4% up or down, okay? And so that's going to be, in your option model, that's going to be based on time to expiration, times your volatility, implied volatility, times your underlying security will give you that option price. So here we're trading at $500. Let's say the expected implied move based on the volatility, implied volatility, is 4% up or down. So that's going to give you a potential range of $520 on the upside, and then the other side of the fence is $480. So it's this range between this expected move up, expected move down of 4%. Is 1 standard deviation. So that's your theoretical price range. Now, when we look at options, we have different option deltas, right, which equate to a probability. I like to look at it as probability of, getting to a certain price point. So basically, this 1 standard deviation price point here would be like a 16 delta. So if you look at this from a standpoint of a delta, and a delta represents basically, it comes from 100%, like 100 shares. So if you look at the delta here, and it was 16, you take 100 minus 16, and that gives you your probability of the theoretical probability of that price being able to get to that price point of 520. So in this example, there's a 16% chance or probability that XYZ, let's say, can get to 520. And if you look at the reciprocal, there's an 84% probability that price will be below 520. Okay, so that's what we can measure theoretically, and that's a great place, or that's the place that we want to start for every trade. So let's say you sold this 480 put, you're going into that trade with the 84% probability that price will be below 480. So exact same way. So that's what we can do with options. We've got these measurements that are really super helpful to helping us determine the best trade.